Imagine working hard all year, paying your taxes, and then one day deciding to live abroad. You picture beaches, adventure, and freedom. But then, bam, the IRS sends you a reminder that even though you live outside the USA, they still want their cut. That's the shock many Americans face when they realize that moving abroad doesn't mean escaping US taxes. But here's the good news. If you know the rules, there are legal ways to save thousands of dollars, and I am going to break it all down for you in this ultimate guide to expat tax rules. Stick around, because there's one tax benefit that could completely change the way you think about living abroad. Number 1. Why expats still pay taxes to the USA? Here's the first question everyone asks. If I move abroad, do I still owe taxes to the USA? The answer is yes. Unlike most countries, the USA taxes its citizens based on citizenship, not residency. That means even if you live in Spain, Thailand, or Costa Rica, the IRS still expects you to file a tax return. Think of it this way. Imagine you're renting out your house in the USA while living in Mexico. Even though you're not living in the USA, you're still making money tied to your citizenship. That's how the IRS sees it. But don't panic. There are special rules that can prevent you from paying double taxes, one to the USA and one to the country where you live. Number 2. The Foreign Earned Income Exclusion. Here's where things get exciting. The Foreign Earned Income Exclusion, also known as FEIE, is one of the biggest benefits for expats. This rule allows you to exclude a large chunk of your earned income from USA taxation. In 2025, that amount is over $126,000 per person. So, let's say you live in Portugal and earn $100,000 working online. You could potentially exclude all of that from US taxes. That's huge. But there's a catch. To qualify, you must meet either the physical presence test or the bona fide residence test. The physical presence test means you've been outside the USA for at least 330 full days in a 12-month period. Imagine marking your calendar. If you spend 35 days in the USA, you fail. The bona fide residence test is different. It means you've truly settled abroad, maybe renting a home in France or getting a long-term visa in Japan. The IRS wants to see that you're genuinely living there, not just vacationing. Number 3. The foreign tax credit. Now, what if you're paying taxes in the country you live in? That's where the foreign tax credit comes in. This credit lets you offset US taxes with the taxes you pay abroad. For example, let's say you earn $80,000 in Germany. Germany taxes you $20,000. When you file your USA tax return, you can claim that $20,000 credit to reduce what you owe to the IRS. This is powerful because in many high-tax countries, your US tax bill can drop all the way down to zero. Number 4. The Foreign Housing Exclusion. Living abroad often means paying high rent, especially in big cities. The Foreign Housing Exclusion helps by letting you deduct housing costs like rent and utilities. Let's say you're living in Tokyo and paying $3,000 a month in rent. Depending on your situation, part of that could be excluded from your taxable income. It's not unlimited, but it adds up fast. This benefit is especially helpful for digital nomads in expensive cities or families relocating for work. Number 5. Filing requirements and deadlines. Here's where many expats trip up. They think, I live abroad, so I don't need to file. Wrong. If your income is above the standard filing threshold, you must file a USA tax return, no matter where you live. The deadline is the same as everyone in the USA, April 15th. But expats get an automatic extension until June 15th. And if you need more time, you can request an extension until October 15th. Example, Sarah moves to Italy in January and earns $60,000. Even though she paid Italian taxes, she still must file her USA tax return. If she doesn't, she risks penalties and interest. Number 6. Reporting foreign bank accounts. This one catches a lot of people by surprise. If you have foreign bank accounts with a combined balance of $10,000 or more at any time during the year, you must file what's called an FBAR, Foreign Bank Account Report. Example, you open a savings account in Spain with $7,000 and another in France with $5,000. Even though neither account alone hits $10,000, together they do, and you must report it. The penalty for ignoring this can be massive, up to $10,000 per violation. That's not something you want to mess with. Number 7. Foreign assets and FATCA. In addition to FBAR, there's FATCA, the Foreign Account Tax Compliance Act. If you own certain foreign assets worth more than $50,000, you must report them on Form 8938. Example, you buy a rental property in Mexico worth $100,000. That must be reported under FATCA. It might feel like the IRS is spying on you, but the truth is, many foreign banks already report U.S. citizen accounts directly to the IRS. So trying to hide accounts usually doesn't work. Number 8. Self-employment taxes abroad. Here's a tricky part. If you're self-employed, like running a freelancing business abroad, you may still owe U.S. self-employment taxes, which cover Social Security and Medicare. For example, if you earn $50,000 freelancing in Bali, even if you exclude your income with FEI, you might still owe over $7,000 in self-employment taxes. Some countries have totalization agreements with the USA that prevent double payment into Social Security systems. Countries like the UK, Canada, and Germany have these agreements, but many do not. Number 9. Tax treaties and how they help. The USA has tax treaties with many countries. These treaties prevent double taxation and spell out special rules for students, teachers, or retirees. Example, a U.S. teacher working in France might benefit from a treaty that exempts certain income from double taxation. The key is reading the treaty carefully or working with a tax professional who understands the details. Number 10. State taxes and residency. Many expats forget about state taxes. If you move abroad but keep ties to a state, like owning a house or having a driver's license there, that state may still tax you. Example, John leaves California to live in Thailand but keeps his California home and voter registration. California may still consider him a resident and demand taxes. The solution? Sever as many ties as possible, close bank accounts, sell property, and get a driver's license in a no-tax state before leaving. Number 11. Retirement accounts abroad. Do you still pay taxes on your retirement accounts if you move abroad? Yes, usually. Contributions to U.S. retirement accounts like IRAs or 401(k)s still follow U.S. tax rules. Example, you withdraw from your 401(k) while living in Spain. The USA taxes it, and depending on the treaty, Spain might tax it too. This is an area where planning is critical. Number 12. The golden ticket. How expats pay zero federal tax. Here's the part one promised earlier. Is it possible for an American abroad to pay zero U.S. federal income tax? Yes, and many do. Imagine this. You live in Vietnam and earn $100,000 from remote work. You qualify for the Foreign Earned Income Exclusion, so that's excluded. You also pay some taxes in Vietnam, and you use the foreign tax credit. Combine these benefits, and your U.S. tax bill can drop to zero. Of course, you still must file, but legally, you could owe nothing. That's why so many Americans choose the expat lifestyle. Number 13. Why you still need professional help. The rules are complicated, and the penalties are high. One wrong step with FBAR or FATCA could cost thousands of dollars. Even if you file your own taxes, it's smart to consult a tax professional who specializes in expat taxes. They can help you maximize exclusions, avoid double taxation, and keep you safe from penalties. Number 14. Tax rules for married expats. If you are married and living abroad, your filing status can change how much you owe. Married expats can choose to file jointly or separately, just like in the USA. But here's the twist. If your spouse is not a U.S. citizen, you must decide whether to include them on your U.S. return. If you elect to include them, their income is also taxed by the IRS. If you don't, you may lose access to certain deductions or credits. Example, an American married to a Spanish citizen may decide to file separately to avoid bringing their spouse's Spanish income into the U.S. system. Number 15. Social Security benefits abroad. Did you know you can still receive Social Security benefits while living abroad? The USA sends Social Security payments to most countries. But in some countries, like North Korea or Cuba, payments are not allowed. Also, your benefits may be reduced if you do not have enough U.S. work credits. Example: a retiree living in Portugal can collect monthly Social Security checks directly into a Portuguese bank account. Number 16. Child tax credits for expats. Even if you live abroad, you may qualify for the child tax credit if your child is a U.S. citizen with a Social Security number. This credit can reduce your tax bill by up to $2,000 per child. Example: a family living in Mexico with 2 young children can still claim up to $4,000 in credits, even while abroad. Number 17. Capital gains on foreign property. If you buy property abroad and later sell it, the IRS still taxes the capital gains. This includes homes, land, or even vacation apartments. Example: an American buys an apartment in Paris for $200,000 and sells it later for $300,000. The $100,000 profit is subject to U.S. capital gains tax, though treaties may provide relief. Number 18. Foreign business ownership rules. If you start or invest in a business abroad, there are special reporting requirements. You may need to file Form 5471 if you own part of a foreign corporation. Failing to report can result in penalties of $10,000 or more. Example: an American digital nomad sets up a small company in Estonia. Even if the company makes little profit, it still must be reported to the IRS. Number 19. Inheritance and gift taxes abroad. If you inherit property or money from a foreign relative, or if you give gifts abroad, you may still have to report them to the IRS. For large foreign gifts, you must file Form 3520. Example: if your uncle in Italy leaves you $200,000 in his will, you must report it, even if Italy already taxed it. Number 20. Currency exchange and reporting. Living abroad means you are dealing with foreign currencies, and the IRS requires you to report everything in US dollars. This means you must use official exchange rates when filing taxes. Example: if you earn 50,000 euros in France, you must convert that to US dollars when reporting to the IRS. Number 21. Student loan deductions for expats. Expats paying U.S. student loans may still qualify for the student loan interest deduction. This allows you to deduct up to $2,500 of interest each year. Example: a teacher in Japan paying off U.S. student loans can lower their taxable income by claiming this deduction. Number 22. Health insurance and the Affordable Care Act. Expats are not required to buy health insurance under the Affordable Care Act mandate, which was a big worry in past years. However, expats may need to consider whether they will be covered by local health insurance or private plans. Example: someone living in Canada may qualify for Canada's public health care, while someone in Thailand might buy private insurance. Living abroad is exciting. New cultures, new opportunities, and maybe even lower living costs. But taxes are the part nobody tells you about until it's too late. Now you know the rules, the benefits, and the traps. You know how to use the Foreign Earned Income Exclusion, the Foreign Tax Credit, and the Foreign Housing Exclusion. You know why FBAR and FATCA matter and why state taxes can sneak up on you. So here's the big question. If you had the chance to move abroad and legally reduce your tax bill to almost zero, would you take it?